So with financial intermediaries, one of the most important is going to be the investment banking process. Now, the investment banking process, what we have to focus on is that we are looking at how we select an investment banker and how we actually go about raising the funds that our company needs for expansion, okay? So we're going to break this down into two stages, okay? With stage one being the point at which we do a lot of the planning, okay? So stage one, what's going to be involved at stage one is going to be able to figure out how much money I actually need, right? Do I need $500 million, right? That is the decision that I need to make. I need this much capital in order to fund my growth, okay? So that's the first decision we need to make. The second decision, this is all part of stage one. The second decision that we need to make is we need to be able to figure out what are we going to use. Are we going to be using stocks? Are we going to be using bonds? Are we going to be using a combination? Are we going to be using convertible bonds? Are we going to be using preferred stock? There's a whole variety of things that we can do. And this is something we need to be working on in stage one, okay? Some of the things we're going to be looking at later in the course for how we actually value these things. But we need to make this decision, what actual instrument are we going to be using to achieve our goals, okay? And then the last thing that we want to do is select an investment banker, okay? This is a very can be a time-consuming process because there's a huge number of investment bankers out there between Goldman Sachs, Barclays, Citigroup, a number of those other big players out there. We have to be able to come up with who is going to get us the best deal, right? And because all those investment bankers, they are in it for themselves to make money. Investors themselves, right, that are purchasing these bonds and stocks, they're in it to make money for themselves. And me as a company, my objective is to raise as much capital at the lowest cost, okay? So these are the first things we need to do. This is what we refer to as more of a planning stage, okay? And this is something we can figure out. Companies are going through this all the time, figuring out if they need to raise money or not. And then a lot of times they might not even make it to stage two because they might say, you know what, it's not worth raising these funds right now. Okay, so we're going to move into stage two. Okay, and this is some of the more important stuff and the stuff that we're going to be focusing on in here. But when we're looking at our stage two decisions, what we're doing is we are reflecting. Okay, we're basically looking back and saying, is this actually worth it for us to go out and raise money? It's going to be expensive. We have to pay these investment bankers to do this process for us, okay? Now, the way that we do this, and when we select our investment banker, we also have to figure out a compensation for the investment bankers, okay? Because there's a couple of different ways that we can do this. The first of which is we can have an underwritten agreement. Okay, the investment banker might underwrite it, the alternative measure, so that's option one, and then we have option two, which is going to be what we call a best effort. Okay, the difference here, okay, is that if we underwrite it, is that actually means the investment banker is purchasing the shares from you and then selling them themselves, right? So they actually give you the cash up front before they have sold it to any investors, right? They give you the cash. So an example of this would be a used car. Okay, basically when you go up and you visit a car dealer, right, and you sell them your car, right? They are giving you cash for the car, and the car dealer is taking that car and then they are going out and reselling it. Okay? So the underwriter themselves, the car dealer, is assuming the risk. Okay? The other measure is on a best effort, is that this would be something that would be on consignment. Okay? So they will take this on consignment and they will say, hey, if I sell your car, I'll give you 5% or 10% of the sale price. Okay? You still own it. I never take possession of it, but you own it the entire time. I'll sell it for you and I'll take a cut off the top. Okay? Most of the arrangements that are done by investment bankers are through this best effort. Okay? But a lot of times they will underwrite these issues. Okay, so that is one of the major things that we're looking at here. Okay, now all of this stuff right here comes under the umbrella of flotation costs. Okay, because investment bankers, they are in their job to make money, right? They want to make money for their employers. They want to make money for their shareholders, okay? So they're going to try and make as much as possible. However, they are in the business of raising money for people so they can do it more efficiently than my company can if I am an auto manufacturer. I stick to auto manufacturing, they stick to raising money, and we all end up working out better. So then the last thing that we have to do is we have to set an offer price. Okay, we have to tell the market how much we are going to be willing to accept, right? And so this is essentially, we put a sticker price on the car and we try and sell it to somebody else. Whereas in this case, we are of course trying to sell a bond or a stock. Okay. There isn't a whole bunch of negotiation between the investment banker and the investor. Basically what happens is you set the price, investment banker set the price, they'll pick up the phone and they will call another investor or email or whatever and say, hey, I got this, you want to buy it? And they tell them the price and they say, yeah, sure, I'll take it. Okay, it's not one of those back and forth bickering processes. Everyone's busy people, they just evaluate the things very quickly, see if it is a worthwhile investment or not, okay? And that's the basic way that we come up with a valuation and the way that we come up with issuing capital, okay? That's the basic investment banking process. Next, we're going to look at the actual way that we compute the flotation costs and how much the investment banker will actually get paid.